Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, it is the hour of the Australian Finance Podcast. How are you going?
I'm doing great. This is probably my favourite time of the week when we do these Q&A sessions.
Is it really? Oh,
I think it honestly is. I know
Sorry,
it honestly is. Sorry, kids. Sorry, kids, tennis friends. This is what I live for.
Yeah. Even better than a bit of a spicy margarita up on overlooking the beach there. I mean, I'll take that.
It's this moment where I black out my whole office, have all these lights on, and do this Q&A.
Yeah, cool. That's good. We've got questions on. Well, for what it's worth, I like to be here too, so thank you. There questions on rent vesting, parents and money and savings fund, saving, in an emergency account. Got a question about education bonds and what those things are. So we'll get to that in a sec. But what's been going on with your week?
Busy week, always. Oh yeah, I'm so stressed actually.
Yeah, you're stressed.
So
Yeah, let's be real.
I'm very stressed. I'm very stressed because I'm moving. And yeah, you'd think I'd be a pro at it by now, but it's really getting to me this time. I don't know why. I think because it's like I'm moving into a house that I'm buying, and so settlement has to happen, and it's just all these moving parts that haven't happened before, and probably like Christmas and stuff. But it's been a really, really good week. What about yours?
For people that haven't kept up, you've bought your house, and has that settled? Like, have you got the keys for that? No. And
it settles next Friday.
Next Friday, so a week from now.
But I'm in Melbourne next week, so I'm like packing at the moment.
So you're packing to move house, but also packing to come to Melbourne, and then you're selling another house to fund that one.
And they have to settle on the same day. And the person that's buying mine that has to settle has like pushed out. So it's unconditional now, but they did, push out finance a few times and different things that just made me a little bit nervous.
Wow. So would you do it again the same way if you were doing this kind of, because this is, for folks that don't know, this is what we call like an upgrader. Gemma is an upgrader. This is like the step that most people take after their kind of first home. They kind of get the bigger house that's good for the family for many years. Would you have any advice for people? Would you do it differently?
I tried to do it differently. So the house that I bought, I found and then decided wasn't really looking. But I got a 3-month settlement on that because I was like, awesome, that's going to be plenty of time to sell. I had to sell 2 properties. So one sold really quickly, and then the other one just kept getting delayed and issues kept happening. So it wasn't online as quickly as I wanted. And then all of a sudden that 3-month window that I had to stress-free sell. So I didn't put this property subject to sale, which you would usually do if you were selling others. But I was like, I've got 3 months. This will definitely sell. None of the real estate agents that I'm talking to will be an issue. It just so happens that the lady that bought it is settling on the same day. So yeah, but the short answer is no, I won't. I won't ever be buying another house. I won't ever be moving again. This is forever.
Yeah. Okay, so good advice for anyone is just give yourself as much time as possible, maybe even go subject to sale. If you're buying a house, but you need your current one to sell. Yeah.
Yeah, and the reason I didn't do that is because I really wanted this house and I wanted to be the most favourable terms, and I was very confident that, they would sell. It just so happens that this lady's settlement is on the same day. So.
Wow. Okay, cool. My week, I don't think much has happened. Maybe a bit of, shameless plug. I did get an award last week, which was the first award that, I think it was last week or this week.
It was last week.
Yeah, Tali got the Big Dog Award. She's the Community Impact of the Year. So there's these awards that go out in the finance industry for everyone that don't know. And Tali got the honours of the Community Impact Award, which recognises people like financial professionals, advisors like she is, who do great work with the community, and she definitely does that with her own entrepreneurial stuff that she does to get women into finance and into careers that they want to be in the finance industry. And yeah, I got a little one too that kind of looks like the Tesseract, and so I was pretty happy about that. And other than that, we have just been kind of doing some things around the office. We've kind of finally figured out a bit more with our studio. We've got new lighting. We got new tables and stuff like this. It's just a bit of a better. Looks like we actually do podcasts full time now, so that's quite good. And yeah, it's just the same old cruising into Christmas. Pretty hectic, but we're getting there. There was a more important update that happened throughout this week. Some people may remember that last week we had a bit of a debate whether it was Nike or Nike. And what has the community told us? How have they fact checked us on this one, Gem?
So the community has fact checked me. So apparently it is Nike, but I did a survey online and it was 50-50. So I don't really care which the legit way is. As Australians, we say Nike, I think. But yeah, so the community was like, Gemma's wrong. So I was reading through the comments. Some people were like, we were screaming at the radio. Is this rage bait? It definitely wasn't. I genuinely will say Nike and think Nike is a bit ridiculous. But then they put it to us that we both need to say how we say the other sports brand that has 3 stripes.
Mm-hmm. So, okay. So, do you want me to go first or do you want to go first?
You go first.
I think it's Adidas.
Oh, yeah. It's definitely Adidas. But so Americans say Adidas.
Oh, yeah, Adidas.
Ridiculous.
Yeah,
Ridiculous.
which is silly. Yeah.
Actually, my best friend's Kiwi, and she says, I'm not even going to be able to say it. So we say Subaru. She says Subaru or something. And like the first few times she said it, I could not even recognize the word that she was trying to say. Subaru, is it?
Yeah, wow.
Yeah.
Well, it's kind of like, I guess this, if you do want rage bait for everyone that listens to the show, the number one piece of rage bait would be, is it Palmy or is it Palmer? If you ask me, it's Palmer.
Yeah, so South Australian, because I'm Palmer. South Australians and Victorians say Palmer, and Palmy is Queensland.
Yeah.
That rages me, actually.
Yeah, that's a frustrating thing. So, so for anyone care to write into us, send it via Gemma at. But yeah, is it Palmer or is it Palmy? And where is the dividing line? Because someone said to me that in Albury, which is on the border of New South Wales and Victoria, some people say Palmy there. So that's kind of very far south. So I want to know, is this just like a South Australian Victorian thing? We're the weirdos. What do you say down in Tassie? That would be really good to know. But there was one extra thing that we brought up last week, Gem, which was Barefoot Investor wrote about this for many years, is does HECS go to the grave with you? So if you've got a HECS bill, because we talked about the 20% reduction from Elbow, thank you very much, Elbow, for cutting our super and cutting our HECS and boosting property prices. What happens to my HECS if I was to die today?
Yes, so we had to fact check this one because I wasn't 100% sure if something had changed in the last few years, but I have done the research around it. So if you pass away and you have a HECS, a help debt, an education type loan, what actually happens is when your estate is finalised, they have to do a tax return for your estate because you've likely earned in that financial year. So if you're over the threshold for making a repayment to your HECS based on your income, that payment has to be made. So if you're over that $67,000 threshold, a payment would have to be made onto your HECS, but the balance after that is then written off. So the estate will have to potentially make a payment, but it's only your repayment for that year. It's not actually covering the whole balance.
Okay.
So if you have an earn over that threshold and you don't need to make a payment onto it, then your whole balance is written off.
Okay, so the balance, for the most part, dies with you. It just disappears.
The balance dies with you. You just might have to make one. Your estate might just have to make one of the income threshold payments on it, depending on where your taxable
just like a normal
income
tax
has
return.
Landed. Yeah.
Okay, cool.
So that's still it's accurate. It's good news. It dies with you, essentially. Yeah.
Yeah, that's a good one. Okay, and there was one final reminder here that you wanted to get in before we get into questions and we do the warning, the general advice warning. What was the note that you wanted to make? Because we've been receiving a lot of questions.
We have been getting so many questions, and there is so much detail coming into them, like people's whole situation. And I just wanted to point out that, like, because people take so much time and energy to write this all in. And so I'm so thankful that they take the time, but they're not the questions that we can answer on the podcast because they're way too detailed. They've got too much information, can't give any personal advice. So if you really want an opinion on your specific situation, like I'm seeing a lot coming through at the moment, you would be much better to jump on the website, shoot us through an email, book in one of our calls, book in for financial advice, like a discovery to see if those kind of services are appropriate for you. On the podcast, we just need to be really talking about super general stuff, something that we can educate you on, but we can't really give you an opinion. We definitely can't give you an opinion on what you should be kind of doing and what things you should be tweaking. So I just wanted to mention it because I want people, people spend so much time putting so much detail in there, and I want you to know that we're not ignoring those ones, but we literally can't address them.
So it's just about when you send your questions in, keep it as a funny name. Try to focus on the topic rather than that, like, should you? So should I do this? Could I do this? Would you do this if you were me? Like, try to avoid those types of questions and try to keep it like you might be able to be creative and bundle that up as, like, instead of should I put more money to super and this is my situation, it could be like, what are the pros and cons of putting money in super for a young person? It's general. Yeah. We don't know who you are. So, it's better that way, and it's safer for us to answer that question. So just try to do that, and we will generalize because we don't want to get stung either. Like, we respect that people should get personal advice, and those are the rules. Speaking of which, I'll do the general advice disclaimer, which I do every week. We don't know your needs, goals, or objectives, so it's better to speak to a licensed and trusted financial planner before you act on any of the information in any Rask podcast. And if we do mention something like, say, a super fund, that will have a PDS, product disclosure statement, and a TMD, target market determination. Both of those documents are available on the provider's website. It's the same thing for insurance or ETFs or something like that. Like, those have disclosure documents that you should read. And if you need more information about, like, what's the difference between the general advice you get on a podcast versus personal advice from a financial planner, you can head to the Rask website, rask.com.au/FSG, and that kind of spells out, like, what we do is general advice. We do have a personal advice business, but that's kind of separate to the podcast, and you sometimes hear the financial advisors come on the show, but that's separate. So, like Gemma said, if you want personalized advice, people to tell you exactly what to do and when, or even potentially do it for you, that's where you go and you get personal advice, and you can find a link in your podcast player or YouTube description to go to that. The first question comes from Volatility Victim. That's an interesting name. Ever since I was a child, my traditional boomer parents have always told me to put my savings in a high-yield savings account where it's kept safe. But with bank interest low and volatile ETF growth, what's the smarter move? Follow my parents' advice to save or invest the bulk of my net worth after keeping a 3-month emergency buffer? So generally speaking, it's like, there is a kind of ingrained legacy with some older people, but also just people in general in Australia, that shares are like gambling. Obviously, we've got this new thing called ETFs, and everyone's seen the stock market go up over the long term because we're more financially literate. But also, there's like kind of our pragmatist parents that say things to us like, put your money in the bank account, all these types of things. It's safe there. Gemma, what do you think?
Well, yeah, so this is really, really common that we see this kind of stuff. But I was kind of like impressed that the parents were educating even on what a high interest savings account was. Because like, sometimes it's like, put your money under the mattress is the advice that you get. So I was kind of impressed by this. But I love that this person has also acknowledged that they need an emergency fund, and then there is stuff that they could be doing with this money. So it really depends. I know we say that all the time, but like, what's the goal for this money? Is it long-term wealth? Are you going to need it within X amount of years? So there's probably a place for both, right? Is it your emergency fund and then some other money that's for a different goal in one of these things, which is great advice from your parents? And then is it other money that's in ETFs or shares and different stuff? So I think it's actually is great advice, but you're right. You should be thinking about, does all the money need to actually be there? And is there something else that you could be doing with part of it, depending on what the goals are?
Yeah, yeah. Like a common one for younger people, I'm assuming this person's younger because they're quoting their parents, is buying a house. And one of the kind of contexts in which we get asked this question is, should I be using this money as a deposit? And if I am, where do I put it, kind of thing? Do I put that in savings or do I put it in investments? Um,
Yeah.
I just generally think that unless you're going to put the money somewhere for like 3 years or more, it's probably better to be defensive. Now, that doesn't mean you can't just you don't have to do, it doesn't mean do all cash and have no investments in ETFs, but it may mean, for example, that if you've got a housing goal in say 3 years or a big monetary goal in 3 years, you might go, oh, okay, I'm going to put like 80% of my money into the cash and then I'm going to put the 20% into, some ETFs and that sort of stuff. So I can start to learn how that feels to be invested. And also you feel like you're getting ahead and you've got something going on. That's what I would do. Go,
Yeah,
Jamie, what was I saying?
one other point on this is I do see people educated around this, and then when they become a homeowner, they're still in this I need a high interest savings account mode where an offset account might actually be better for you. So that's where I kind of see, down the track, someone's 40 and they're still using high interest savings accounts when potentially an offset account was better for them. So that's the only kind of thing that I would say is this is probably great advice right now, but you want to make sure that as your situation changes, you are also exploring the different kind of accounts that might suit you a little bit better.
Yeah, definitely. Yeah, good point. Yeah, offset accounts almost always are better once you have a mortgage. So, Broker Joker says, hey guys, love the pod. Just wanted to know if having your core and satellite in 2 different brokers is a good idea. I already have 2 brokers and don't know if I should merge them all into one or keep them separate. Thank you, says Broker Joker. I'm happy to go first here, Gem. I think it's fine.
Well, should we
And
start with what is core and satellite?
okay, yeah, sure. So a core portfolio, for people that don't know, is a real low cost kind of boring investments all go in one place. It's typically like ETFs. You probably hear of names like Vanguard, BetaShares, who sponsors the show, BlackRock or iShares. These are the names of like the big ETF providers in Australia and throughout the world in some cases. So those ETFs typically go in your core along with like blue chip shares, which are like the more mature ones. But then in your satellite, you can have kind of the more growthy, the more risky style of investments. And this might only be like 10% of your portfolio, 20% of your portfolio. It might be $100, whatever the case may be. But in this part of your portfolio, you can be a bit more kind of edgy, a bit more kind of fly close to the sun and kind of see how investing works. A common strategy from an admin perspective is people go, okay, I'm going to like automate all the investments into my core boring stuff. And the satellites, which are these smaller positions that are kind of like a bit more risky, I'm just going to put money into my brokerage account and then every day or every week or every whatever, I'm going to log in and check to see how they've gone. And I'm going to use that as kind of my experimental space. Now, I'm quite a fan of using multiple brokerage accounts. I think a lot of people that listen to the Rask podcasts often think like they have to go with one brokerage account, kind of like they have to go with one super fund just because they read it in a book or they read it on Reddit or something like this. But you don't have to. And I'm a fan of keeping my core money away from my satellite money to the extent that I can track both. Now I say this, Gem, but in the next few weeks, our Rask Invest platform will allow people to do core and satellite in the one place. And that's just because people have asked us for that. But like, for example, I have some shares with Perla and I have some shares with ComSec. And I also have like a Raise account, and they're all kind of like whatever goes. Like they're just a bit of fun kind of money. That's my satellite. And then my core portfolio, obviously I can keep in Rask Invest as like low cost ETFs and that sort of a thing. So that's how I approach it, Gem. I don't necessarily think there's anything wrong with it, but I'm curious to hear your thoughts.
Yeah, I don't think there's a problem with having more than one platform, but from an administration point, like if you do want to have it in one, you need to consider that if you are going to do that, if it becomes onerous and you're like, no, I want it all in one place, you might need to actually sell down those assets to do it, which can be an issue. Some platforms, depending on if they're like CHESS sponsored, you can transfer the asset, like transfer the actual holdings over. But yeah, I wouldn't be too concerned with having different ones because we kind of talk to people about doing that anyway. Just start with one just to get in, and then if you decide that there's a platform that works better for you, just leave that where it is and like going forward, start with the next one. So I absolutely don't have a problem with having more than one, but if it is annoying you, just consider, can you transfer them into one, or do you actually need to sell down? And is it worth actually doing that?
Yeah. We know that like tax is a reality, and one of the admin things that becomes annoying is having multiple logins and that sort of stuff. So there's a way around this for people that still need to do their tax, or they want to get like all their figures in the one place. You can use a tool called Navexa or ShareSite. We've had Navar from Navexa on the show before, had Doug from ShareSite on the show before in the past. And basically what these are, this is like a third-party software, and it kind of plugs into your brokerage account. And you can have like basically unlimited number of brokerage accounts. And what happens is they read all of the transactions that happen. So then you get kind of one big tax reporting tool, one overall picture of your wealth, and you pay like a subscription of like $20 a month or something. I don't know what it is. Navar could tell us, but it's like $20 a month. And it kind of, at the end of the year, you can just literally click a button that says produce tax report or my ATO tax report. And what it does is it just kind of collects everything and then goes boom into one piece of paper. And it's like, this is what you put at this point. This is what you put at that point. This is what you put at this point. And then throughout the year, you can kind of, see how your portfolio is performing in aggregate across all of the different positions. So that's a good tool that you can use. Bond, children's bond. Now, Gemma, you did change this person's name because you think that they use their full name.
I picked that. Yeah.
Yeah. So you changed it to...
How clever am I, though? That's funny.
It's pretty good. Yeah, Bond, children's Bond. I've actually been going back and watching all the James Bonds, just because that's a thing you do.
I think I've even seen one.
Really?
Yeah.
You've never seen
I also plan to go through my whole life never watching a Star Wars. Pride myself on it.
Are you serious?
Yeah.
You just lost. So when you said James Bond, you just lost 20% of the audience. Then when you said Star Wars, you just lost another 40% of the audience. So now you're slowly getting closer and closer to that corner of the room where no one wants to be friends with you.
All right, the editors can cut that out. Make me look cool.
Well, Star Wars, I don't know if that's cool or not. But anyway, cool in a nerdy kind of way. I think it's like a white middle-aging male. I think I just do what every white middle-aging male does, and I just kind of cycle through James Bond, Jason Bourne, maybe not so much Tom Cruise, but you just kind of keep cycling through these kind of oldies but goodies. So the question comes from Children's Bond, as you've put it in. Should I use Australian Unity to invest my children's money? You're going to need to tell us what this is. I think most people would know Australian Unity from like health insurance or something like this. So What is Australian Unity really? And why would they be asking about investing for their kids?
Yeah, so what they are referring to is Australian Unity has a investment bond or an insurance bond product. So where you can invest money for the long term. They're quite structured products. They have a different tax consideration and tax benefits. So with this question, I'm assuming that this person has done lots of research and decided that for their situation, an investment or an insurance bond is the best way for them to do it, because it's quite a complex thing, and you would consider lots of options, investing in your own name, investing in the children's bank accounts versus shares, and you'd consider an investment bond. So I'm assuming that they've already decided that this is the best avenue for them, and potentially they've kind of weighed up, because there's lots of providers in Australia that do these investment insurance bonds for kids. And generally what happens is, if you hold them for over 10 years, they can be like capital gains tax-free. So they're long-term investments. Within them, you can pick a portfolio, like depending on the risk and the assets kind of that you want within it. So yeah, I'm assuming that they're just like, hey, I want a bond. Should I go with Australian Unity? But there's Australian Unity, there's Generation Life, there's Centura, IWF, AMP, there's probably some others. So while I can't comment, should you go with Australian Unity, what I was going to say is, well, how do you actually decide? Because there's so many providers. So I thought we would focus on, well, what do you actually look at when you're comparing them? But yeah, the assumption is this person's already decided that this type of investments are right for them. But yeah, that would be absolutely the step beforehand, before picking their provider, is actually working out if this is the right product for you, because they are quite complex.
Yeah. So some people may remember, I think it was late last year, we had Grant Hackett on the show, the famous athlete and swimmer who's now the CEO of Generation Life, or the parent business of that. So I think that Generation Life is the biggest provider of this in the country now, which is an investment bond. So really important to understand that an investment bond is different to a bond that you invest in. I know this sounds weird, but
finance is ridiculous, but yeah.
yeah. So an investment bond, if you just took that name, or an insurance bond as it's sometimes called, but an investment bond, just think of that as like what we call a tax structure. So it's just like superannuation, except it's not super. Like it's got some of the tax benefits similar to what super might have, but you can access it earlier if you have to. You lose a lot of the tax benefits if you do that, but if you do access it, but it has some tax benefits. The other things that we sometimes talk about are like government bonds or bonds in a portfolio or bond ETFs. They're very different. They're just like a normal ETF that you can just buy and you get monthly interest or whatever. So they're different. What they're talking about in this instance is the first one, so the investment bond, and they've made a decision that they want them. A few of the things, just quickly before we get to the, like, how do you choose between them? I would just say, as a general gist, that investment bonds are not appropriate for most people. Like, just straight up, they're not appropriate. No matter how you cut it up, they're just not appropriate. So make sure you've done your math right. We do recommend them in our financial advice business, but in the right circumstances and assuming that people are going to follow the rules of the bonds.
Yeah, so they're usually for high income earners because the bonds are taxed internally. Like, imagine they have like their own tax file number. They're like super. It's got like its own little bubble outside your marginal tax rate and how you're taxed with work and things. So they're internally taxed at 30%. So you have to kind of be a high income earner to make that part of it worth it, and then consider, if you'll be able to meet all of the other conditions to get the tax benefit after 10 years.
Yeah. So how do you compare them? Fees is obviously one thing. Some of them are pretty high, but they've come down in some ways over the last 10 years because they've become more sensible and realistic. The other thing to keep in mind is that how much flexibility do you have with the bond? So what we call an investment menu. So like because it's like even though we say it's a tax structure, everyone, it's kind of like super. Like you don't just see this like invisible tax structure or go past you on the street or something like that and you go, oh, what's that? It's actually like you need to log in and there's an online account and then you're inside the bond, so to speak. Kind of like when you log into your super fund. And once you're in there, you can select from different investment options, similar to your super, like balanced growth, or you do DIY it. With an investment bond, it's the same, except the menu of investments that you have is often limited. And so before you sign up to one of these providers, you can go to their website to see which options do you have available. Like, for example, with Generation Life, I know with them, they have Vanguard. So you could invest in Vanguard strategies inside the bond. Yeah. So that's one thing to consider. What else would you think about?
Yeah, and definitely fees. So once you've picked what you want to invest in, then you would check for a similar asset allocation with the ones that you're comparing, because it's like a super fund. There's no point comparing someone's balanced to somebody else's growth. The fees are going to be totally different, and it doesn't give you an indication of which is like a true representation of the fee. You need to be considering a similar asset allocation. So first of all, you would go, how do we actually want to invest in this? What's our risk profile? And then you could compare them based on fees, and you could look at their performance as well. So with the investment option that you want to choose, you could look at their long-term performance. We don't care year in, year out. We want to look at like as long as possible, as close to 10 years as you can get.
So this is important because for most of these bonds, everyone, you need to be invested in them for 10 years to get the tax benefits. There are some different bonds, and I think Australian Unity offers one, which is like an education bond. Yep. It's the same tax structure, except there's one tweak to it, which is that you can use the kind of proceeds from the bond to pay for educational expenses. So that could be used by grandparents, parents, whoever.
So you can kind of make withdrawals for education purposes without stuffing up the 10-year, the 10-year thing.
10-year rule. There are a lot of other rules, but that's just generally how it works. And then finally, and you've got this in our notes for today, Gem, is how easy are they to deal with? Like,
yes,
they used to be so unbelievably terrible to deal with, like.
And this is like some super funds. Like, we talk to clients and we're like, hey, yes, they might be lower fee, but they are so hard to deal with. Do you want to deal with that? So I don't have an opinion on Australian Unity. I'm just saying, like, maybe look at their website. Like, if you're going to compare stuff, Maybe you call their call center. Like, just look at that kind of stuff as well, because sometimes we go cheapest and it comes back to bite us.
Yes, definitely. And so like when we spoke to Grant Hackett in the episode and he talked about it, he was saying like some of the new features that they have, like, so there are a bunch of different rules that you need to adhere to with these things, but how easy do they make it to make sure that you don't stuff up? Like, for example, like everyone knows that you could probably pay money into your superannuation and boost your super, but there are rules around how much you can put in before you get huge amounts of tax or there's penalties or whatever. Wouldn't it be nice if the super fund said, hold on, Gemma, you went to put in 31,000 and the rule is 30. So we're going to send you back the 1,000, right? Wouldn't it be nice rather than you just getting a letter from the ATO being like, naughty. Like, so what they have done in the last few years is that a lot of them have invested in their technology and got better. You can start one of these accounts with like $2,000, right? So it might be worthwhile just trying it with like $2,000 and being like, oh, okay, that's how it works. And then maybe if your overall budget was $6,000, you could try 3 of them, for example, or after reading reviews and that sort of stuff.
Yeah. This is like having multiple brokerages, right? Like you can have multiple bonds if that's what you decide is the right avenue for you.
The reason why people don't normally start with a couple grand, and you can, because like that's how I would do it, to be honest, is that there's another rule that kicks in called the 125% rule, which is that you can't put in more than 125% of what you put in last year. So $2,000 this year, 125% was that $2,500. So you can't go and add a lot more than what you put in the first year. Now you can have multiple bonds and blah, 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 blah. But that's another rule. So some people don't really tend to put in smaller amounts because they want it to grow and they think maybe next year I'll put in a bit more. So just keep that in the back of your mind. We'll put links in the show notes to more resources. But ultimately, I just want to ask you a very simple question. Gemma, we've talked about them. Do you use one for the kids?
No. I don't have one for the kids because I already had like family trust and all of that kind of stuff set up. And to be honest, I think they'd be too restrictive for me because like I think they're perfect for people that are really sure with their cash flow. They know every single year they're going to have that 125 or whatever. Yeah, they're too restrictive for me. I don't want.
Yeah, okay.
I want that.
But like we have a lot of grandparents that come through for financial advice and they will have like 5 different bonds of like just a couple grand in each. And because they know that after 10 years the kids could get it tax-free, or if they die then the kids get it immediately tax-free, so on and so forth. So
I've definitely recommended them to clients, yeah, for sure. Yeah. But yeah, I don't.
Yeah. Okay, cool. Final question, which you are going to summarize for us, because this is one of those questions that got sent through with so much good information, but we just couldn't read it all out on air because it was probably too close to the personal advice rules for us and we weren't really comfortable. But it was from Rent Vest No More, Gem. So what was the question?
Yeah. So they had lots of amazing information. I very much saw myself in this question. So the takeout is, like their question that we're going to answer today is, when do you exit your rent vesting strategy when you decide to be a homeowner now? How do you go about it? So the person's example is they have 5 properties, and if they wanted to own a home outright, they would probably need to sell 4 of them. So the question that we're going to answer is, when do you exit? When you want to exit being a rent vestor because you want to own a family home, how do you actually go about doing that? And this is literally what I've just done, right? So I've just bought a house, which I'm so stressed about right now because I'm going to move into it. And I haven't had a family home that I've owned for over 3 years. I've had investment properties. So the big consideration here, like why rent vesting doesn't work in this situation, is because there's capital gains tax on those properties. So this is the big stitch up with it. But I'm okay with paying tax. I want to be tax effective, but I wasn't ready to be a homeowner for those years. My properties have had lots of growth. I'm actually okay with that. But this is quite one of the downfalls with rent vesting, is when you decide you want to potentially buy a primary residence, you're going to have to sell them and you're going to have some capital gains tax.
Gemma, can you just explain what rent vesting is for people that don't properly know the acronym or the phrase? So
yeah, definitely. So rent vesting is when you rent the property that you live in, and maybe that's because it's in an area that you don't want to buy a house. Maybe it's short term. Maybe you live in an area where renting is much more cost effective than being able to buy. Maybe you need to be close to the kids' school or whatever. So it's where you rent where you want to live, but you still have investment properties that mean that you're building wealth in the Australian property market. So I actually really like this strategy. As I said, I've been doing it, but I do believe that for most Australians to be able to retire comfortably, I honestly believe you need to own the home that you live in at some point. You don't necessarily need to do it while you're accumulating, but you need to do it at some point. And my point has come where I've decided that that's what I want to do. So for these people, they're like, we need to sell 4. I had to sell 2. They need to sell 4 to be able to get the property. Ideally, if you could do that over different financial years, you're going to potentially lessen that tax a lot more. But you just never know. So my advice to them would be go to a really good accountant and start calculating the capital gains tax on each property and see if doing it all in 1 year, if you're high income earners, it won't make a difference. Doing it all in 1 year versus staggering it, how that looks. And then go to the bank and see if we sold 1 property and we had this big deposit, could we borrow? If we sold 2, could we borrow? And I would just nut out different scenarios and saw if, because potentially you have a home loan, but you sell a property every year that then chips away at that home loan, and within 4 years you're debt free. Does that make sense?
Yeah, it does. Yeah.
So I think an accountant is your best friend here to work out the capital gain on each, and then work out which one could you sell to get you in the house, and potentially it's the one with the biggest cash, like that you're going to get out of it. And do you need to actually all do them? And what's the tax difference versus the interest you might pay on having a mortgage? This is all strategy, this situation.
I was chatting to Monique, our podcast manager, yesterday before, and she was like, just got a tax return. I'm like, oh, that's nice. I don't think I've had a tax refund, I should say tax refund, like money coming back to me since 2012.
Yeah, it's been a while for me, which is a privileged position to be,
It is, but it's not like my whole point to literally everyone that I speak to in my personal life and to everyone listening to this and watching this is when you become an investor, you will stop getting tax returns. There are tax refunds. You will not get money back. You are paying money because you are earning money. And if you run a business, you are paying a shed load of tax for other people. It's just how our society has seemed to have worked so far. So as you get on, and you see this in any of the financial independence bloggers or investors that you might hear on this show or other shows from Rask, ultimately, you are going to be paying tax. And so it comes down to how do you minimize the amount of tax that you're going to pay? If you built wealth in property, you've built a shed load of wealth. So you've probably got big capital gains tax, which is the tax that you pay on the profits from selling. It's not as simple as like shares because there's depreciation and a bunch of other things. It's hence why Gemma said to go to your accountant. But ultimately, you're going to be paying tax as you become an investor. Splitting your big tax bills over multiple years is a pretty common strategy. So, for example, you might sell one house this year before June 30th and then one after June 30th, and that's enough. Another way might be, what can you do once you know you're going to have a tax bill? Could you make extra contributions to super and claim a tax deduction? Could you have set up the new investments in a family trust? Could you buy the investments in your share portfolio through a holding company? Could you invest in your partner's name, which is lower tax? Could you use an investment bond? These are all the options that you would consider. But once you're already on this journey, you pay tax, and it's about how do you minimize it, and tax is a reality.
Yeah, and it's not a bad thing. It means you made money, but being tax effective is important. And then there's a strategy on once you've got your tax, like what your tax bill is. So my accountant has worked out what my capital gain from these 2 properties, and I had to sell them in the same year. So I'm going to have a lot of money sitting with me for as long as possible before I have to pay that tax bill. So I've swiped it off. I know exactly what it's going to be. I do have to have a home loan on the new property, but I'm going to use all that tax money. I'm going to just put it in the offset on my own home loan, not on the other investments, just on my home loan to the last minute possible that the ATO wants that tax paid.
Yep. Cool. So having a good accountant is one of the big strategies here. That's good to know. So I've had questions about, putting money in an emergency fund versus investing. You can do a bit of both, I can't even remember the Portuguese or the Spanish phrase, but it's Adrian who...
Nolos dos.
Nolos dos, that's the one.
I think we say it wrong every time.
Yeah, we do.
Well, can't even say Nike, so.
That's it. Palmy. Broker Joker said, talked about core and satellite. Always a great idea to have a core and satellite portfolio, in my opinion. Bond, children's bond, which was Gemma's one. We went deep on investment bonds. We do have the Grant Hackett episode. You can also find information online. James in our team, who's our wizard for tax and everything tax optimization of your life, wrote this amazing guide for people. It's totally free. You can just Google Rask tax structures guide, and it covers investment bonds, it covers family trust, it covers how to make the decision of which one might be better. So that's called the Tax Structures Explained. It's a free guide. Everyone who wrote in today can get a free pass to Rask Core, which is our membership. It's fully revamped. We've got case studies and financial strategies for all different types of personas in there. We're rolling out a bunch of different hypothetical couples and singles and retirees and accumulators and professionals and tradies. We're basically giving you a financial plan in general advice. And so you can see what this kind of hypothetical person looks like, and then see how a financial planner would design a strategy for their life. We've got weekly shows and investment research and stuff. So that's all inside Rask Core. You can sign up today by heading to the Rask website, or if you wrote in a question, for next week, we will give you a free pass to Rask Core. So just get in contact with us online. Final thing is Gemma's stressed this week, but we would love to hear your questions. If it's about Gemma's property saga, or if it's about something else, we would love to hear it. So write in via the link in your podcast player or in the description for YouTube. We've got some fun Christmas episodes coming at you. Gemma and I are actually going to record one just in a minute that will air in a couple of weeks, and I'm super excited. So go and subscribe to the series wherever you do that, and have a great day. And Gemma, always a pleasure. So thanks for joining me.
See you next week.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.